Good evening and welcome to the Money Show, the only one of a kind show that you have on your television sets. India's first and only show which brings markets top financial experts to answer all your financial queries. I'm Karunya Rao, and over the next half hour, all we'll be discussing is your queries and all of your concerns regarding your financials. Let's kickstart the show then and welcome in the first expert that we have on the show with us, Feroz Aziz, Deputy CEO of Anand Rathi Private Wealth Management. Feroz, hi. Welcome to the Money Show and to ET now. We'll just touch upon how much is enough for retirement. That's an important topic that we'll be touching upon with you, Feroz. Let's straight start with the query number one. Prashant Bhatt has written to us. He says he's a 47-year-old and would like to retire in the next 2 years. I currently have a corpus of 2 crore, he says, and he owns a flat and does also receive a rent of 25,000 per month, and his yearly expenses are about 18 lakh. He also has a 15-year-old daughter who would like to pursue medicine in 2021. That's the year that she's looking at for education. What's the ideal corpus and average inflation rate to take into account? That's his main concern, his main query, Feroz. And which mutual fund should he invest to achieve all of the goals that he has highlighted? And he's also given his expenses as well, apart from what he's making on the sideline. So, Feroz, let's get on straight to addressing his queries. What would be your recommendation to him?
So I think Prashant has done a good job by laying down a good foundation, because his child's education is one of his objectives, retirement is another objective. Of course, he has to factor in inflation when he's planning for his retirement. From his pointed question, to answer his pointed question of what should be the inflation number, to my mind, an 8% aggregate inflation number is what a person of his nature should factor in. Of course, the RBI publishes lower inflation numbers, but the things which we end up consuming, being in an urban city or even a tier 2 city in India, the inflations are far more, numbers are far more than the basic CPI number. So 8% is the inflation, Prashant, you should take into account. Point 2 is, of course, you will have to make sure that you have a mix of equity and debt to be able to achieve a good return. You already have a corpus of 2 crores, which is a good thing to do, but you have very little while to retire, which is just 2 years from now. So you'll have to have a mix of equity and debt. Let me recommend some good equity funds to start with. ABSL Equity Fund, Aditya Birla Sun Life Equity Fund, is a good equity fund which is largely focused on taking the top blue chip companies in the portfolio. On the mid cap space, you can look at Mirae Asset India Equity, which has some degree of mid cap, but largely the bigger companies. And on the debt side, Axis Credit Risk and Reliance Credit Risk Fund could be the 4 funds which you can put all in equal quantums to create a good portfolio of equity and debt mixed along. All
right. Let's get on to query number 2 then. We have Sumit Manna, who's written to us. He's given us a fair idea and a list of all the mutual funds that he's been investing in over more than 13 years now, and wants to know if he can generate about 2 crore worth with the help of your guidance. Now, looking at his portfolio, he has SBI Blue Chip Direct, where he has, I think he invests 6k, L&T Mid Cap Direct 8k, Mirae Emerging Market, another 6,000 invested there. Canara Robeco Emerging Fund is another one where he's invested 10,000. L&T Small Cap Direct, 7,000 goes there, and Most Focus 35 Direct, another 10,000 gone there. Looking at his portfolio, what would be your advice to him, and do you think it would be possible that he can amass 2 crore worth using by staying in this portfolio?
Yes, I think if you look at the portfolio and his investment quantums, 2 crore rupees in 13 years is fairly achievable. But having said which, I think Sumit should keep into mind the inflation which is going to eat into the value of the 2 crores over 3-year period, 13-year periods. That's a large inflation which he has to counter. So 2 crores today looks like a reasonable quantum, like in the previous example, previous caller Prashant we were speaking of. But I think for Sumit, I think he will have to factor in an inflation number for which you will have to escalate your systematic investment plan on a every year basis by 10%, so that you're able to compound, you're able to counter the compounding inflation pressure on the money. That's point one. Point two, out of the 6 funds you've chosen, 4 of them are good. You can stay invested. 2 funds which require minor modifications, one of them a minor modification. SBI Blue Chip Fund, which is a good fund, but I think in the same basket of SBI Asset Management Company, there's another fund called SBI Focused Equity. To my mind, that has more complementing nature to the other 4. So move from SBI Blue Chip to SBI Focused Equity Fund, which is a concentrated 23-24 stock portfolio managed by a gentleman called Vasan. So that's one change. The other change is the Motilal Oswal Focused 35 Fund. I would ideally replace that with Aditya Birla Sun Life Equity Fund, because the focus on or the Motilal Oswal Fund has a large skew towards financials, almost about 35-40%. I think ABSL Equity Fund would be a better choice.
Thanks for that query, for addressing that query from Sumit. Moving right on, Monica Chawla is our third viewer who has written to us. She's 52 years old and says she can invest for the next 10 to 12 years as well. Wants to add some small pure equity mutual funds for her retirement perspective, and she has also started monthly SIPs just now in direct plans and has sufficient cash in the bank and also has sufficiently invested in liquid balance as well. Let's talk about the funds that she has invested in at this point of time. ELSS Tata Tax Saving Fund, 12,500 gone there monthly. L&T Emerging Businesses, 50,000 monthly SIP is what she has subscribed to. Franklin Prima Fund, 50,000 per month goes there, and Kotak Standard Multi Cap with a 1 lakh monthly SIP. Tell us, Feroze, then, what do you think about the investment she has made, and what would be your advice to her?
I think if you have to score Monica's portfolio on a scale of 10, 10 being the highest, I think she's done a wonderful job in choosing the right mutual funds. Almost all the 4 mutual funds, she can continue investing these large amounts of SIPs, 50,000 and a lakh. And of course, she has an ELSS scheme which helps her save tax on a recurring basis. She's investing in that. So the schemes are good. One thing which she has mentioned when she has written to us is that she intends to invest in balanced funds also. She does invest in balanced funds. At least I very strongly suggest against that, because data clearly proves that if you mix an equity fund alongside a good debt fund, this combination will be has beaten a balanced fund by a reasonable margin. So balanced funds are a no-no. You would rather combine equity and debt yourself if you have quantums of this nature to monthly invest. So if somebody has only 1,000 rupees to invest and wants exposure in debt and equity both, then definitely a balanced fund comes as a convenient tool because it mixes both the assets. But if she has 2 lakhs of a systematic investment plan being done, then I think she can mix them herself. So that's one small input. Otherwise, the schemes are very good, Monica. I think all the best. You're doing wonderful.
Right, all right. Feroze, just request you to be on hold with us while we address an important segment of our show, which is Sahi SIP. Let's get on board then Saeed Sagir to talk a bit more about it. He's the head private client group at Sundaram Mutual. Let's get on with the segment then and take it across to him. Well, hi, welcome to ET Now. My first question to you would be, and everybody out there, or all of us, all of those who are watching us would like to know, why is the right amount of SIP important? We all talk about SIP so much, but how to choose it? Why is the proportion so important?
See, again, SIP is a much abused term nowadays. It's become very generic. So when people say SIP, basically they mean 2,000 ka SIP or 3,000 rupee SIP or 5,000 rupee SIP without actually factoring in a lot of things. So when we say Sahi SIP, it means the right amount of SIP taking into account all your circumstances. For example, a person who's young would have different goals. A person who's older would have different goals. A person who is earning a certain segment in a salary bracket would have different goals. So all those things put together have to be factored in. And what happens is, if we don't do this, it results in investors to be disappointed. Basically, if I am earning 2 lakh rupees of salary and I still put 2,000 or 5,000 rupees as SIP, that doesn't feed into my goals. I'm not saving adequate amount of my money, and I'm not going about in a very systematic fashion. So that's not called SIP, that's just ad hoc investment.
Okay. And also, help us understand how should one arrive at this Sahi SIP that we've been talking about?
Yeah, so well, you all start off with the investment objective first. Investment objective is one which will keep someone grounded. So if you have the investment objective, you will not veer away, especially in these times when markets are volatile. People will not panic and sell. They know they have an investment objective in place, and that investment objective can be anything and multiple. So it can be a son's education, it can be a daughter's marriage, it can be your retirement, it can be broken up then further into medium-term goals, into long-term goals, and then basically you can also have multiple time buckets for it. Once you have the bucketing done, the next thing which you will essentially do is calculate the rupee amount for that. So for example, if you need 1 crore of rupees for your son's education, you know that amount right away. You know you need 5 crores for your retirement, you know that amount right away. That is in your hand. Now you will do a back calculation on that, saying that this is the kind of SIP or amount I have to put in every month to accumulate that kind of an amount. And how do you do that? You know the historical returns on various classes of equity like large caps, mid caps, small caps. You will do that and arrive at a blended return. So let's say I arrive at a blended return of 11 or 12% for a right mix of large caps, mid caps and small caps. What I do is then I calculate the amount which I can save. Let's say that comes to 20,000 rupees a month. And if it's doable, I go ahead with it. If it's not doable, I have to tinker around with the variables. Probably extend my horizon a bit, probably tone down my goals, or probably take a slightly higher risk. So all these things put together would facilitate a person to do a Sahi SIP, which would actually move him towards his investment goal, and not just frantically just do a random generic SIP because his friend said so. So just to reiterate, have your investment objective, which is very clear. Second, come up with your goals, calculate the monetary amount, and work backwards to calculate how much of the rupee amount you have to allocate every month towards your short-term goals, your medium-term goals, and your long-term goals.
All right, Syed, thanks so much for taking time out and helping our viewers understand how important it is to choose your SIP in the right amount and how one can actually sit down and choose the Sahi SIP. With that, we'll slip into a short break. We have Feroz with us. We'll get him on board on the other side to address some more of your queries. Welcome back. You're still watching The Money Show right here on ET Now. And Times Network and the Association of Mutual Funds in India have recently launched Jan Nivesh, an invest education initiative that's getting people to pledge to invest their one day's income into mutual funds for long-term benefits. You too can be a partner of the growing Indian economy by investing in mutual funds. Join the Jan Nivesh movement and give a missed call on 1800 833 to pledge to invest your one day's income into mutual funds. And while we were on ground conducting the Jan Nivesh campaign, we had a few queries. Let's go across to it. Alok is the first one, and he says that fund houses seem to be placing faith in small cap funds again, launching new schemes or reopening older ones for fresh subscriptions. But what he essentially wants to know is, should one invest in small cap funds while the markets are cracking? Would it be a good idea? Feroz, what would be your advice?
So Alok, I think if you're looking at a small cap fund, yeah, sure, Mr. Rao. Alok, if you're hearing us, that it's important to take things in context. Of course, small cap indices have corrected in the last 6 months by about 30%. That's a large correction, which opens up an investment opportunity for fund houses. That's why they have reopened for subscription. But it's important when you evaluate a small cap fund, you will have to look at it in context, because small cap funds are going to bring in risk to the portfolio, just like they have in the recent times. But as long as you are buying not more than 10 to 15% of your overall portfolio in a small cap fund, then it's certainly a good strategy to get some extra return on the portfolio. If you're buying too much of it, quite a few of us get carried away with the past performance of small cap funds and buy a larger quantum than 10-15% of the portfolio, which is not advisable. Point 3, if you're looking at small cap funds, look at small cap funds which are well diversified. For example, a Franklin India Smaller Companies Fund, then a concentrated portfolio. So I've also given you my recommendation on the small cap space. Rather than taking concentrated bets and increasing further risk, I think you should take a diversified small cap fund if you so choose to have one.
All right, Feroz, let's move on to query number 2, which is again an on-ground query from Mr. Rao. He wants to know, are index mutual funds and Nifty index mutual funds the same thing? And if so, what are the pros and cons of investing in one?
See, Mr. Rao's query, index funds and Nifty index funds are similar. So Nifty index fund is a type of an index fund, as the name suggests. So index funds could be mirroring several different indices, but Nifty index fund mirrors the largest index of the country, or the most popular one if not the largest, which is Nifty. So Nifty index fund is a subset of an index fund. Now coming to what are the advantages, what are the disadvantages of index fund. Index fund in Indian context is not a very good investment, because mutual funds, by doing active buying and selling, have created extra return more than the index. That's called the alpha of the fund. Alpha is nothing but the extra return which a fund manager uses his capability to generate for its investor. Barring the last 7-8 months, last 10 years says that active management has created value for its investors. So index funds are not a very good option currently. But the advantage of that index fund is they are low on cost. Now, as per SEBI's regulation, the cost of index funds cannot exceed more than 1%, vis-a-vis an active managed fund, where a fund manager is doing all the effort to give you extra return. The cost can go as much as 2-2.5%. The cost is lower, which is the biggest advantage. The biggest disadvantage is you let go of the extra return which the fund manager's intellect and research throws up over long periods of time, if not in the short span of time.
Right, before we get any further, I just want to remind our viewers that we are open to taking their queries live on the show as well. They can call us right away on the numbers flashing on their screens. It's 67549474. That's the number that's flashing right on the bottom of your screen. Give us a call and get your queries and your doubts addressed by our expert. But Feroz, coming back to what you were talking about in the meantime, while you have addressed Mr. Rao's query and told us the difference between the two, if asked what is the medium that you prefer investing, what would be your recommendation or your preferred platform?
See, one are open-ended schemes which are actively managed, where there's a designated fund manager who is going to be picking up stocks and doing better than at least is expected to do better than the index. So my preferred choice would be active managed funds. Index funds are also called passively managed because there is no fund manager trying to use capability to better the index. The entire energy is going to replicate the index. In a situation like an emerged market like US, 80% or even more, the money invested in mutual funds is towards passively managed or index funds, which are synonyms to each other. So my preferred route to answer your pointed question will be actively managed open-ended scheme, where there's a fund manager trying to add value to you by beating the index and not just mirroring it.
viewers were able to understand the difference and will be, able to take a prudent call. We have a live caller on the show. Let's get him on board. Then Mahesh Chaudhary has dialed in from Odisha. Mahesh, hi, good evening. Thank you so much for taking time out and talking to us and discussing your queries with us. Bring it on then and tell us what is it that you need to know.
Good evening, madam. I have a mutual fund, HDFC, DSP, BlackRock and ICICI.
Okay.
Potential mutual fund and Aditya Birla Sun Life.
Okay. What would you like to know?
These are funds I have with me for the last 1 year, and it is in down -15. It is in down.
Okay.
Whether I will continue with it or I will search for other fund managers.
Okay, Feroz, take it away then. Mahesh wants to know whether or not he should continue with all of these funds that he just listed out.
See, Mr. Chaudhary, I think you have 4 funds. Point 1 is you've just mentioned the fund houses, not the funds, but out of these four fund houses, 3 of them are reasonably stable and strong. DSP, which is one fund house which has had some degree of fund management change, especially the CIO, Mr. Anup Maheshwari, has moved out. So I think I would not be in the fund which is DSP. Of course, they've shown immense capability in managing small cap funds, but I can do without it. The other 3 fund houses, HDFC, ICICI and SBI, if I remember right, are good fund houses, one of the largest fund houses, in fact the top 3 fund houses of the country. So you can continue irrespective of the scheme, but it's also important to understand the scheme you hold, not just the fund management company. That's relevant to all viewers. People need to understand the schemes more in depth and rather than just the fund house. And coming back to your second part of the question, which says the market is down, what should one do? Mr. Mahesh, I think you should hold on because equity markets actually display this behavioral pattern of going back and falling 10-15% time and again, and if you look at returns after that 1-2 years from then, things are okay and you will make more money. That's what history has to teach us. So don't panic, just stay the course. If you have made an SIP for 5-10 years, just stick to it and be disciplined, and I think the road at the end, the light at the end of the tunnel is there. So don't get perturbed with the current correction, which has happened numerous times in the past and things have been okay so far.
All right, Mahesh, thank you so much for calling. Hope we've been able to help you, with your query and with the concerns that you have regarding your portfolio of mutual funds that you've invested in. And Feroz, thanks to you as well for taking time out and helping us understand the various aspects and also addressing our viewer queries. With that, it's a wrap on the show. Thank you so much for watching.